Okay, so you want to own a mobile home park. Picture the cheapest real estate play in America. Dirt lots, some gravel roads, a sign at the entrance that hasn't been repainted since the 1980s. No elevators to fix. No roofs to replace. No tenant calling at 2 in the morning about a broken water heater because you don't own the water heater. You don't own anything inside the fence line except the ground itself. That's the pitch. And on paper, it sounds like the most boring, low-maintenance asset class in the entire American economy. Here's the part nobody puts in the brochure. In a normal apartment building, if you raise the rent too high, the tenant packs a truck and leaves by the weekend. In a mobile home park, the resident already owns the house. They just don't own the dirt underneath it. And moving that house, hauling a 14-foot wide structure down a state highway, costs more than most of these families make in 2 months. Some of the wheels are technically still bolted on. Most aren't. The hitch was cut off years ago, the skirting was mortared in, a wooden porch was built onto the side. The home stopped being mobile the day someone stopped renting a truck and started renting a lot instead. That's the business. Not selling homes. Not selling land. Selling the one thing a family can't walk away from without losing what they already own. Wall Street noticed. And once Wall Street notices something quiet, it stops staying quiet for long. Over the next 30 minutes, we're going to walk through exactly how this business actually works, who owns the dirt, who owns the debt, and who ends up owning almost none of the upside despite living inside the asset every single day. Ask most people what a trailer park is, and they'll describe a stereotype: cheap, transient, low income, temporary. Ask an institutional investor the same question and you'll get a different answer. Recession-resistant, capital-light, structurally undersupplied real estate with a customer base that can't leave. Both descriptions are talking about the same set of properties. Roughly 20 million Americans live in manufactured housing communities, and the industry housing them is, by real estate standards, still shockingly fragmented. Compare it to other consolidated sectors. 3 companies own about 80% of America's billboards. 5 companies run almost the entire global cruise industry. 4 airlines control nearly the whole U.S. domestic market. Mobile home parks don't look like that. Not yet. Of roughly 40,000 parks nationwide, fewer than 4,000 belong to institutional owners. That's under 10%. The rest are still mom-and-pop operations, a retired couple who bought the land decades ago and has been collecting lot rent checks ever since. That gap is exactly what drew private equity in. Watch how quickly the numbers climb once you start counting private equity's specific footprint. 13% of manufactured home park purchases from 2017 to 2019. 23% from 2020 to 2021. 23 separate firms, controlling more than 1,800 communities today. Each number on its own looks manageable. Stacked together, in order, they describe a market share moving in one direction only, and moving faster with every reporting period. To break into the top 100 apartment owners in America, you need more than 70,000 units under management. To break into the top 100 mobile home park owners, you need about 600 lots, 6 or 7 mid-sized parks. The barrier to building an empire here was never scale. It was that almost nobody with institutional money had bothered to look. So here's the illusion. A mobile home park looks like the housing of last resort, the option families choose when they've run out of better ones. And here's the reality underneath it: a fragmented, underpriced, functionally captive rental market. One economics researcher studying the sector found that lot rents nationally sit roughly 50% below fair market value. Underpriced relative to what exactly? Relative to what a landlord could charge if the tenant literally could not leave. That's the opportunity a growing list of private equity firms decided to pursue. Between 2017 and 2019, institutional investors made up about 13% of manufactured home park purchases nationwide. By 2020 and 2021, that share had grown to 23%. Today, at least 23 separate private equity firms collectively own more than 1,800 of these communities across the country. The residents inside them didn't choose their new landlord. They found out who it was when the return address on the rent letter changed. And the private equity firms aren't even the biggest players in the room. 2 publicly traded real estate investment trusts, Equity Lifestyle Properties and Sun Communities, have been consolidating manufactured housing communities for decades. well before the current wave of private equity interest. Sam Zell, the investor who founded Equity Lifestyle, was buying up parks back when Wall Street still considered the entire asset class beneath its attention. What's changed isn't the strategy. It's how many firms have finally noticed it works. So let's say you actually want to do this. Buy the park. Collect the lot rent. Live the passive income dream the weekend seminar promised you. The entry price is lower than almost anything else in commercial real estate. A rundown, unglamorous park in a rural county can trade for a few $100,000, sometimes less than the price of a single luxury condo in a major coastal city. That low basis is the entire hook. It's how a handful of self-styled mobile home university instructors built a following of dentists, engineers, and retirees convinced they'd found real estate's last free lunch. But the entry price is only step one. Here is the sequence of costs that shows up after closing. Each one a small twist you don't see until you're already holding the deed. First, infrastructure. You don't own the homes. You own the water lines, the sewer system, the electrical grid, and the roads underneath them, usually built decades ago, sometimes never brought up to modern code. Replacing a failing septic system for an entire community can run into six figures before a single new resident moves in. Second, occupancy. A park that looks full on the rent roll isn't necessarily full of paying tenants. Vacant lots need a home sitting on them to generate income, and used manufactured homes aren't always easy to source, transport, or finance for a new resident. Third, regulation. Manufactured home communities are governed by a patchwork of state-specific landlord-tenant law that has almost nothing in common from state to state. In North Carolina, an evicted resident has 21 days to physically remove their home from the property. In other states, the timeline and the rules are entirely different. There is no single national rulebook. There are 50 different ones, and you need to know all of them before you raise a single rent check. Some states cap how much notice a park owner must give before an increase. Others cap almost nothing at all. That patchwork isn't an accident of history so much as a reflection of how little national attention this specific corner of housing policy has received, right up until the ownership behind it started consolidating fast enough for regulators to notice. There's a fourth layer most new operators don't budget for at all. The homes themselves are aging out of the system. Federal law only allows moving companies to relocate manufactured homes built after June 15, 1976, the date HUD's National Construction and Safety Code took effect. Homes built before that date are, for practical purposes, frozen in place forever, whether the resident wants to move them or not. Every year, more of the housing stock inside these parks crosses further into that territory. Too old to move, too expensive to replace, and increasingly dependent on the park owner simply leaving it alone. Meanwhile, a small industry of paid seminars has grown up around teaching outsiders how to buy into this asset class quickly. The pitch at these mobile home university boot camps is consistent. Attend a weekend course, learn the acquisition playbook, and start collecting lot rent within a year. The course materials themselves lean on the same demographic argument, again and again, that with a large share of American households earning $20,000 a year or less, and thousands of retirees a day moving onto a Social Security check that averages a few $100s a week, the demand for the cheapest form of housing in the country isn't going anywhere. Now here's where the real hidden cost, and the real hidden opportunity, actually sits. It isn't a cost the operator absorbs. It's a cost the operator can pass straight down, level by level, and the resident has nowhere to redirect it. Level 1. The base lot rent, whatever the previous mom-and-pop owner happened to be charging, usually well under market. Level 2. New service fees layered on top of that base, water metering, trash pickup, stormwater management, line items that simply didn't exist under the old ownership. Level 3. Rising property insurance and property tax, both of which climb faster in regions facing more frequent severe weather, and both of which get passed through to the same rent roll rather than absorbed by ownership. Level 4. The annual increase itself, compounding every year on top of a base that's already grown 3 times over. Stack those 3 levels together and you get what happened at one community in Michigan, Swartz Creek Estates, after a private equity firm called Haven Park acquired it in 2018. Lot rent went up. New fees appeared. Within a relatively short window, the total cost to residents had climbed by 40%. 40% on a bill that a retiree living on a fixed Social Security income cannot simply absorb by cutting back on something else. And this is the barrier to entry that actually matters. Not the cost of buying the dirt, but the willingness to raise the price on people who have no exit. Frank Rolfe, one of the pioneers of the modern mobile home park roll-up, has been candid about the math for years. He's on record telling prospective investors that residents can't afford the $5,000 it takes to move a mobile home, which is exactly why an owner can raise the rent without losing any occupancy. In his own words to course attendees, the customer is stuck. They can't afford the few $1,000s to move the trailer. The only alternative they have is walking away and abandoning the home entirely. Walking away means losing a house they already paid for, in full, years ago. That's not a footnote in the business model. That's the business model. So how does the actual machine run? Once the paperwork is signed and the rent notices go out, start with the obvious layer, lot rent. This is the recurring, largely automatic revenue stream. A fixed monthly check from every occupied space, with none of the maintenance burden a landlord carries in a conventional rental. No roof repairs when a resident's water heater breaks. No new appliances when a tenant moves out. The home itself, and everything inside it, sits on somebody else's balance sheet. That's layer one. It's the layer investors talk about publicly, in earnings calls and investor decks, because it's the layer that looks the most defensible, a low volatility, contractually recurring cash flow, resistant to the kind of downturn that hits office towers or hotels. Occupancy in an established, well-located park barely moves year to year, because the alternative to paying the higher lot rent isn't a competitor 2 blocks away. It's a moving truck the resident can't afford. Layer 2 is where the real leverage lives, financing. And this is where a name most people associate with folksy, shareholder-friendly capitalism enters the story, Warren Buffett. Berkshire Hathaway owns Clayton Homes, the largest manufactured home builder in the United States. Clayton doesn't just build the homes. Through its lending arm, Vanderbilt Mortgage, it also finances them, often at interest rates well above a conventional mortgage, sold to buyers who frequently have no other lender in the room. A 2015 investigation by the Seattle Times, BuzzFeed News, and the Center for Public Integrity found that Clayton-affiliated dealerships displayed large in-store banners promoting only Clayton's own financing, with no comparable signage for any outside lender. Build the home. Sell the home. Finance the home. Collect the interest on the loan. One company, one closed loop, 3 separate profit centers on the same transaction. The customer sees 1 purchase. The company books 3. And Clayton isn't operating in a vacuum. Manufactured homes that aren't permanently fixed to own land are typically financed as personal property, a chattel loan, not as real estate. That single classification changes everything about the deal. Chattel loans made up about 42% of all manufactured home financing in recent years, and according to the Federal Reserve's 2024 survey of consumer finances, they carried an average interest rate of 8.69%, compared with 6.81% on a traditional manufactured home mortgage. 2 lenders dominate that chattel market almost entirely: 21st Mortgage Corporation and Vanderbilt Mortgage, the same Vanderbilt owned by Clayton, owned by Berkshire Hathaway. The approval odds tell the same story from another angle. Roughly 27% of manufactured home loan applicants actually get financing. Compare that to 74% for a site-built home. On the other side of that gap, about 42% of manufactured home loan applications get denied outright, versus roughly 7% for a conventional house. A buyer who does get approved is often approved into the more expensive chattel product from one of 2 lenders, one of which is owned by the same company that just sold them the home. Layer 3 is the exit. Buy a mom-and-pop park under market, raise rents toward, or past, what that same research pegs as fair market value. Then sell the stabilized, higher cash flow asset to the next institutional buyer at a valuation multiple built entirely on the new, higher rent roll. The private equity stakeholder project, tracking this pattern across multiple firms, describes the playbook in 3 steps. Acquire the park, raise the rent to increase the park's paper value, then sell within a few years at the higher price the new rent roll now justifies. Notice what's actually being sold in that final transaction. Not the homes, residents own those. not really the land in any physical sense that changes hands differently. What's being sold is a repriced income stream, extracted from people who couldn't leave when the price changed underneath them. And as we're about to see, that machine runs smoothly right up until it collides with someone who genuinely has no room left to absorb the next increase. The clearest place to watch this model reach its limit isn't a rent notice. It's a courtroom. In January 2025, the Consumer Financial Protection Bureau filed a lawsuit against Vanderbilt Mortgage and Finance, the Clayton Homes lending subsidiary owned by Berkshire Hathaway. The allegation: Vanderbilt had systematically approved manufactured home loans for borrowers who, on paper, plainly could not afford them, by using artificially low estimates of a borrower's monthly living expenses to make the debt-to-income math work out on approval. The CFPB cited one case directly in its complaint. A family of 5 was approved for a loan that left them with $57.78 in monthly disposable income after the mortgage payment. $57.78 for an entire month. For 5 people. Vanderbilt knowingly traps people in risky loans in order to close the deal on selling a manufactured home, the agency's director said in the announcement. The mechanism described wasn't a rogue loan officer or a one-time error. It was a systematic underwriting practice from the same financing arm, inside the same parent company, applied across a customer base that a decade of prior reporting had already flagged as disproportionately low income. This wasn't the first time regulators and journalists had circled this exact company. 10 years earlier, in 2015, that Seattle Times and Center for Public Integrity investigation had already documented the pattern: sales staff steering buyers toward in-house financing, loan approvals that consumed a large share of a borrower's income, and a business built on one company controlling the home, the financing, and, when a borrower defaulted, the repossession that followed. Warren Buffett's response to that first round of reporting, delivered at Berkshire's annual shareholder meeting, was that he made no apologies whatsoever about Clayton's lending, calling the company's practices exemplary. 10 years later, a federal regulator filed a lawsuit alleging the same underlying pattern was still running. In between those two dates, members of Congress had written to the Department of Justice and the CFPB, asking for corrective action against the company. Berkshire Hathaway, at the time, generated a relatively small share of its overall pre-tax profit from this one subsidiary, a rounding error next to the railroad, the insurance operations, and the rest of the conglomerate's roughly 90 businesses. For the families on the other side of these loans, it wasn't a rounding error. It was the largest financial decision most of them would make in their lives. That's the collapse point of this model, in miniature. Not a single dramatic bankruptcy. A slow accumulation of individual households pushed past the edge of what their income can service, a pattern documented, investigated, and litigated more than once by more than one set of investigators, a decade apart. The parks themselves show the same pattern from a different angle. After Haven Park acquired Swartz Creek Estates and pushed costs up 40%, residents weren't dealing with a single company's underwriting decision. They were dealing with a landlord they couldn't negotiate with and couldn't leave. Researchers studying manufactured home communities in Florida found that in the months immediately following a park sale to a new owner, eviction filings rose by 40%. 2 entirely different data sets. 2 different states. 2 different mechanisms. One is a loan approved with $57.78 left at the end of the month. The other is a rent notice arriving after a change of ownership. Both land on the same outcome: a resident who owns a house they can't move and can't afford to keep. Public radio has documented individual versions of that outcome directly. One resident, interviewed after her park went up for sale to an investment group, put the math in plain terms. If her lot rent rose by more than $100 a month, she would have no choice but to sell her home and leave. She said if she'd known the park was headed toward a sale to institutional investors, she never would have bought into it in the first place. By the time she understood the arrangement, she was already inside it. Another resident, in a separate case covered by the same reporting, was evicted for falling behind on lot rent before she could find a buyer for her own home, at which point her home reverted to the park's management, free to be resold or rented out under new terms she had no part in setting. A federal class action is now working its way through the courts, alleging that dozens of parks under common private equity ownership coordinated on lot rent pricing across state lines. The same underlying accusation that keeps surfacing in different forms, that the pricing on the other side of this lease was never really being set by a normal, competitive market to begin with. And as we're about to see, the people writing these rent notices and approving these loans are not the ones absorbing that outcome. Follow the money to where it actually lands. And the winners in this model are almost never the two names that appear on the lease, not the resident. They hold an asset, the home, that depreciates and becomes harder to sell the longer they stay, because the only realistic buyer for a used manufactured home is someone else willing to move into that same park, under that same landlord. Not, in most cases, the original mom-and-pop owner either. Many of them sold years ago, at a price that looked generous at the time and looks small in hindsight next to what the same park is worth after 2 or 3 rounds of institutional rent increases. The winners sit one layer above the transaction everyone else can see. On one side, the private equity firm that bought the park raised the rent toward fair market value and sold the stabilized cash flow to the next buyer, booking the gap between the old rent roll and the new one as pure appreciation, with almost none of it reinvested into the actual infrastructure underneath the homes. On the other side, the vertically integrated lender builder that finances the home collects the interest and, when the loan fails, recovers a home that can simply be resold to the next buyer on the wait list, because that specific park, and every park like it, has more prospective residents than available lots. Both sides of that pair are structurally protected from the thing that hurts everyone else in this business: the customer's inability to leave. That's not incidental to the model. It is the model. A landlord in a normal apartment building has to compete for tenants who can walk away. A mobile home park operator competes for tenants who, once they've bought the home and settled the family in, functionally cannot. Sam Zell, the real estate investor widely credited with recognizing this asset class's potential decades before Wall Street caught up, is remembered for describing the position in blunter terms than any prospectus ever would. You're renting the land under a house to a family that already owns the house, and that family has nowhere else to put it. Compare that to a hotel, one of the more common comparisons investors reach for. A hotel guest checks out the moment the price stops making sense. A mobile home resident can't. The room, in this case, is a life savings account poured into aluminum siding and a wooden porch, and the checkout fee is a moving bill that can run higher than the family's entire monthly income. Look at who carries the risk versus who carries the upside, and the split is almost total. The resident carries the risk that the rent keeps climbing faster than their income. The mom-and-pop seller, in most cases, is already out of the picture, holding a check that looked fair the day they signed it. The private equity firm carries none of the downside that matters. Worst case, the rent increases move slower than projected, and the asset still sells at a premium to what was paid. The lender carries almost no downside either, because the collateral, the physical home, can be recovered and resold into a market where demand for lots consistently exceeds supply. Every layer above the resident is structured to be, at worst, mildly disappointing. Only the layer at the bottom is structured to be catastrophic. Go back to that hitch that got cut off years ago. Nobody removed it to make a statement. They removed it because nobody expected to move the home again, because moving it was never really an option to begin with. That's the detail this whole business quietly depends on. Not a scandal, not a single bad actor. A wheel that was never going anywhere, on a house that was never really mobile, owned by a family that assumed, reasonably, at the time, that owning the home meant they controlled their own housing cost. The rest of the model was built around that one assumption being wrong. 20 million Americans live inside that arrangement right now. Most of their landlords are still the mom-and-pop couple who bought the land decades ago. Some of their landlords are private equity firms running the exact playbook described in this video from a spreadsheet in an office none of the residents will ever see. And as we've seen throughout this video, the share keeps moving in one direction. None of this requires a villain in the traditional sense. Nobody in this chain has to be dishonest for the outcome to play out exactly as described. The private equity analyst is doing their job, maximizing the return on an asset relative to what similar assets trade for. The lender is doing their job, pricing risk and collecting on the loans that perform. The regulator is doing its job too. Eventually, years after the pattern is already established, once enough documentation exists to build a case. Every individual link in that chain can function exactly as designed, and the resident at the bottom of it can still end up with $57.78 left at the end of the month. That's what makes this particular model harder to fix than a single bad actor would be. You can prosecute a scam. It's much harder to prosecute a spreadsheet. So here's what's actually worth asking. Next time mobile home shows up in a headline about affordable housing, is the home affordable because the family owns it outright? Or is it affordable right up until the day someone else decides what the land underneath it is worth? And when the wheels are already gone, who exactly still has the freedom to walk away?